All right, why don't we start with your word of the day?
Bifurcated. And that really sums up the market for the last few months. It's the market either loves a stock and it goes up every day, or it hates a stock and it's gotten really cheap. We think that's the opportunity in looking at the market, not to chase the things that are getting really pricey and to start to look through some of the carnage.
All right, you're looking through the carnage, David? I mean, the S&P and the NASDAQ just hit new highs. Carnage seems like a bit of an overstatement, but I get it. You want to look at some of the underloved parts of the market. Is there one in particular where you're seeing opportunity?
Well, they just reported earnings last night, Constellation Brands, and there is carnage. That stock is down about 40% in the last 52 weeks. It sells at about 11.5, 12 times earnings. Their business is weak. They've lowered earnings significantly this year, but last night they made earnings. They affirmed the year, and you're getting a 3% yield, about 12 times earnings. We don't think their business is going to turn for about 6 months, but at this price, you're getting paid to wait. And you know, as crazy as it sounds, and you had a great point, the market's at all-time highs. It's at 23 times earnings. Technology's at 30 times earnings. But there are a lot of stocks that are down 20 to 40% that sell under 14 times earnings. So underneath the surface, there have been some things that have really done poorly.
All right. Are you feeling this way about other consumer discretionary stocks? I mean, Constellation, a lot of people really enjoy a Modelo or a Corona, but it's certainly not a necessity. Are you seeing other opportunities in some other beaten down name discretionary companies?
Well, we will give you a necessity, Starbucks. They have a new CEO. We think he's doing a real good job of turning around the company. There are always issues when you turn around a company. You're getting paid at almost a 3% yield while you wait there. And we do think there's a good likelihood for success. We think consumers are definitely struggling right now, but we don't think that's going to continue indefinitely. And here's a company that people really do want to own. It is a necessity to get your coffee in the morning or any time in the day.
I think it's a necessity for you, David, but I get what you're saying. I get your point, especially for anybody watching this show. I want to talk to you about the government shutdown. Are you concerned at all about the impact that could have on the markets? We've been talking about this quite a bit. Moody's estimates for every week of the government shutdown, there's a 0.1% of negative impact to quarterly GDP. Is that something that concerns you?
Well, it definitely is going to slow the economy down. If it continues for any length of time, it will slow the economy down more significantly. Typically, if you look at shutdowns since 1976, the market has had a very modest upward bias. And generally, in the times that it's sold off during shutdowns, when the shutdown has been resolved and the government reopens, stocks have recovered that pretty quickly. So from a stock market perspective, we're not expecting anything very significant to happen from the shutdown. From an economy perspective, it definitely is going to slow down the GDP print this quarter. But we do think the economy will recover thereafter.
All right. I want to get your take on just the broader markets again. As we just both talked about it, S&P and NASDAQ trading at all-time highs. We had Paul Tudor Jones on our air yesterday. Here's what he's saying about the current market. I want to get your reaction.
Don't play it.
Right.
You're missing out on the juice. If you do play it, you have to have really happy feet, because there will be a really, really bad end to it. And my guess is that I think all the ingredients are in place for some kind of a blow-off. Will it happen? Again, history rhymes a lot, so I would think some version of it is going to happen again.
Right.
If anything now is so much more potentially explosive than 1999.
All right, David, I'll give you one quick word on this. Do you agree with that thesis from Paul Tudor Jones?
Well, we do think you want to be more cautious looking forward, because we don't think the market is sustainable in terms of having a lot more upside here. You just want to pay attention to valuation.